Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. The U.S. equity market was in retreat in the last session. We had the Dow, the S&P, and the NASDAQ each down roughly 0.3%. Strategist at Bank of America noted the S&P is trading at statistically expensive levels. Even Fed Chair Jay Powell said this week that equity prices are fairly highly valued. Meantime, in New York, U.S. Treasury Secretary Scott Bessent reportedly met with South Korean President Lee Jae-myung. The Chosun Daily reports Lee explained to Bessent that South Korea and Japan are very different in terms of economic scale, foreign exchange markets, and infrastructure. And Lee went on to express hope that trade negotiations would take those aspects into account. In a moment, we'll bring you our exclusive conversation with South Korean Prime Minister Min-seok. But we begin here in the States, and our guest, Rebecca Walser of Walser Wealth Management. She joins us here in the studio. Always great to see you. Thanks so much for stopping by. So you're here for client meetings. You're going to do some media appearances as well. And I'm curious about what you're hearing from clients right now. What are they saying about the way in which this market's been behaving? Are they nervous?
You know, I think a lot of people are a little past the nerves when all of the prognostications in April that came out when we had, obviously Proclamation Day at the beginning of April of what the tariff structure was going to look like. And really, I think the financial media kind of overkilled the message of, oh, this is going to be absolutely horrific. The economy is going to explode. Everything's going to go awful. It's going to be massive inflation. You're going to lose jobs. You're not going to get manufacturing to come back. You're going to have all these problems. And so a lot of people, Doug, actually, unfortunately, not our clients, because we weren't saying that message, but a lot of people out there actually went ahead and really took that advice to heart and sold and missed out. Yes, missed out on some of these big tech, wins, these big IPO wins, these things that we've been talking about all year that are just phenomenal. They didn't participate because they listened to the financial media. So I actually think, my theory is that I think there's some backlash against financial media. Some people are, if you look at the ratings numbers and you see kind of what they've done over since April, you'll see kind of a drifting down. I think that they're upset and maybe going to podcasts and alternative media and things like that. Not that Bloomberg's going to go anywhere, but.
Okay, so let's say that we've added about $15 trillion from that April low. Is that a fair estimate? Something around that if you look at the broader market?
Absolutely.
And a multiple on the S&P right now of about 25 times seems to be a little expensive.
Exactly.
Do you think people generally have become a little complacent?
I mean, I don't know if we're at the 1996 irrational exuberance stage that Alan Greenspan talked about. And if you think about that, that's the year that he said that. That preceded the actual bubble crashing, by about 4 years. So I don't know if people are irrationally exuberant or if really, truly everyone is beginning to understand that this is the end of normal ways of life as we've known them, that this technology is so far outpacing what we can otherwise accomplish just with human capacity. Like the exponential GDP, Doug, is going to be phenomenal. The problem is that how do you continue to make the human actually contribute positively to GDP? Because if you outsource all human beings and we're no longer positively contributing, we don't have to. Well, that's all fine and good, but then how do we work out the economics of what you're earning, what you're making? Do we not have money anymore? Are we really going to utopia? So I don't think there's irrational exuberance, but I do think there's pre-exuberance before we actually monetize. We're in the process of monetizing.
So tell me where you're finding opportunity then.
I mean, I think there's lots of opportunities. We've had some great recent IPOs. We've had some great developments on consumer lending on the blockchain. For example, Figure Technologies, which is basically able to do a home equity loan they're claiming on the blockchain within 10 days, cutting the normal 42-day cycle, which is conventional. So there's a lot of things that are beginning to actually monetize. In other words, we're actually going to use the blockchain. We're not just doing AI, ChatGPT in our daily lives and trying to find a faster route or a better way to write a paragraph. We're actually seeing monetization. That's just the beginning. It's the tip of the iceberg. And it's going to begin en masse. And I think what we'll really start to see is stablecoin coming to forbear, especially since the Genius Act passed, which, as you know, is a 1-to-1 reserve ratio of reserves. In other words, if I issue 20 billion of stablecoin, I have to have 20 billion of liquid reserves in either U.S. dollars or U.S. short-term treasuries, treasury bills. So this is basically the ability to have third parties enter into a currency operation that is backed by the full faith and credit of US dollar, US treasury, but operated and regulated somehow. You'll see an entity coming. We have another act that's potentially going to go through Congress, which will be a regulatory framework for stablecoin. So you're looking at the very early stages, Doug, of the very beginning of a new currency system that would in fact replace the use of the US dollar completely.
Whether we're talking about AI technologies, data centers, or whether we're talking about something that's related to the blockchain, we're talking about a lot of power, demand for electricity. Is that something that you're playing right now? I know when you and I have spoken about this in the past, you've indicated that you're interested in taking some positions in power companies, maybe utilities even. Is that still?
Absolutely. Specifically nuclear power. I think nuclear power is really our only real true scientific mathematical probability of success to have enough power. Traditional coal out, nowhere near the capacity that we need. Gas, natural, everything else beyond, actual coal-fired electricity is subpar, right? So if coal-fired electricity is already, we know not enough power for what the AI checks that everyone's writing on these PE ratios for all these tech companies, the AI checks that are being written off of the multiples they expect AI to come, we have to have the power grid, and we don't have it. Electricity, coal-fired is not going to be enough mathematically, not enough. Gasoline, oil, not enough. We have got to have some kind of nuclear presence. And so I would bet on nuclear stocks where the companies are actually looking at building nuclear power generators or power plants. There's one Oslo that's basically projected to have an actual nuclear power plant operational between 2027 and 2028. It's based in Idaho.
So if these hyperscalers are ramping up at a very aggressive rate, is there the risk that they don't have the power they need?
There's not the risk. There is the absolute mathematical certainty that if we get too much operational AI before the power has caught up, we are sitting ducks. We will have to ration power. There's not enough.
Well, that sounds inflationary too, which then takes me to the Fed. We heard from Powell this week. He said that the near-term risks to inflation are tilted to the upside. So there's the tariff story. We're talking about the power story now. What's your outlook for inflation?
I mean, unfortunately, as you know, I've mentioned to you multiple times, Doug, we really have entered the very beginning stages of a debt spiral. Like, I know no one's talking about it, but the fact that our interest has gone from the fourth largest expense to the second largest expense as fast as it has in the last few years. We hit the second largest expense. It surpassed Medicare, Medicaid last year in May of 2024.
Total debt service.
Total amount paid on the federal budget for that year. We surpassed it. So now it's only second to our mammoth Social Security.
Just under $1 trillion.
And we expect it to be closer to $1.2 trillion next year. And that's with them calculating the refinancing of so much of it with lower interest rates because they have to. Like, we can't afford the interest that we are now being charged on an ongoing basis. It's unsustainable. And unfortunately, because we keep borrowing and we're charging interest on top of interest, that interest grows every single year. And the only chance that we have that our GDP actually outpaces our actual interest growth is AI, is a fourth industrial revolution, is the new frontier of productivity that is just unmatched at the human level.
Are you focused squarely on opportunities in the States, or are you looking offshore?
I mean, I think that there's a lot of robotics that you have to look outside of the United States. You have to look at German manufacturing. You have to look at Japanese manufacturing. You have to look at outside opportunities in this world. The United States is certainly going to be a forethought and a foreleader, but I don't think we're going to be in this race alone, and I don't think we'll finish number one in every category.
So we started the conversation by talking about how far the equity market has run from the April lows and how expensive things are right now.
Yeah.
Are you holding on to cash, or when cash comes in, are you deploying it immediately? Are you fully invested, or is there a little dry powder that Rebecca Walser is keeping on the sidelines?
I mean, I do think that everyone should have a little dry powder at all times, just because there could be something we want to capitalize on that's not a huge, obviously, position or big part of the portfolio. But for the most part, we're pretty fully deployed. We have, the dry powder that we normally have, which we would say at least a 10% position in general. And I would say that, we are just looking for opportunities. I do think there will be, what investors need to understand, Doug, is that monetization of new technology is always bumpy. It is always historically bumpy. It is not from point A straight to point B, a straight line up to the right. It's not how it goes. It's bumpy. And so as long as people are prepared for pullbacks, like we had at one point this year, more than one time, we had people not really happy with NVIDIA. I mean, that these things happen, and it's cyclical, especially as we monetize. As we go from prognosticating value to actual realized value, it gets bumpy.
So you talked about a debt spiral being one of the risks out there that you're focused on. I'm curious about other risks that you see on the horizon.
Well, of course, there's the biggest risk of all, and that is that we are globally de-dollarizing, which you and I have talked about. And we've talked about China's intent in written papers, 100-year plans in place, written that they want to be the number one military and economic superpower in the world, bar none. And that includes taking down the United States of America. So clearly, I think that China and what they've orchestrated economically with their Belt and Road Initiative, what they've orchestrated with really taking over from the Bank of International Settlements, the BIS. They took over the project Enbridge, which was a central bank cryptocurrency project about, central banks transacting on the blockchain and their domestic currencies, central bank digital currencies. I mean, they are just so advanced from a perspective of being on the blockchain and being the new center of kind of financial hub. I mean, if you go to Dubai, you'd think they would be the investment capital of the world. I've been there, and it's insanity for us to be so arrogant that we just think the United States is going to be on the top because of the U.S. dollar.
Even so, the Chinese economy seems to still be struggling. They have a problem with confidence. The real estate market is still not doing well. A year ago, the government made a major pivot in applying a lot of stimulus to different segments of the economy. That includes fiscal, monetary. They targeted the housing market as well. And things still have been somewhat lackluster. That doesn't concern you at all? The fact that the animal spirits in China right now don't seem to be rising to the occasion?
Yeah. Don't get me wrong. I don't want China to succeed. I just see them as a sincere threat. But, of course, Doug, they absolutely have some economic problems, just like I would say to you, like Japan with their debt to GDP, which is over 200%. Yeah. That's economically unheard of, not viable, can't work, and yet it continues to work. So I feel like we are globally very quickly approaching the end of fiat debt, central bank fiat debt. We are going to go to tokenization of hard assets, real reserves, and obviously to currency on the blockchain. And it's going to be a complete shift of currency.
Wow. We'll see where we go from here. Any comments on gold? I know we pulled back a little bit today, but we're very close to record highs. What do you think's happening here? Is this all about central banks and then the retail crowd that came in at the last part of the rally that we had?
Yeah, I mean, I think absolutely it's central bank related. You have Basel III that went into effect, which basically moved gold from a tier 3 asset to a tier 1 asset and really made the central banks want to step up and own it for all of the things that meant as far as reserves at their central bank. But also, Doug, again, we are closing in to the end of the people's belief in fiat currency, the fiat debt system, the fiat money multiplying system. I'm on a fractional reserve system. I had to give you 100, you lend out 90. Now we have fake money because there's not really 190. There was 100 and it became 190. So the money multiplier, fractional reserve, all of these things, when we move to the blockchain and it's all publicly notable, traceable, seeable, that's why you've got like the Stablecoin Act the Genius Act that requires these stablecoins to have a one-to-one reserve relationship so people can trust it and it'll be on the blockchain, it'll be transparent. So we are getting close to the end of fiat currency and the government can issue whatever they want.
All right, we'll leave it there. It's always a pleasure. Rebecca, thank you so very much. Rebecca Walser is president of Walser Wealth Management, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. The U.S. and South Korea are still trying to finalize a trade deal, and these negotiations have included discussions around investment projects in the U.S. However, South Korea's prime minister says those projects will remain in limbo now until visa issues are resolved. Prime Minister Min-seok spoke exclusively to Bloomberg Shery in Seoul. Here's part of that conversation.
This negotiation wasn't initiated by us. We didn't start from a position of advantage, nor did we raise the issues. Isn't that the case for the entire world? Since the whole world is negotiating under the new conditions presented by the United States, rather than insisting on specific conditions, the correct answer would be that certain things are simply difficult to achieve. Therefore, anything that exceeds the limits of what the Republic of Korea can bear in terms of national interests, acceptability, capacity, or public understanding will be quite difficult to undertake.
Are the issues that need to be resolved around the $350 billion investment fund into the U.S.?
That's generally the case, since the framework for the large amount is already set. The fact that the amount is fixed means it started with the expectation that depending on how that amount is structured, it could potentially be mutually beneficial. However, the structure itself, how the funds are raised or how the profits are distributed, these things need to be within the bounds of what's considered normal. And when explaining to our Korean citizens, it needs to be at a level where they can understand and accept it. Above all, it must be within the capacity of our Korean economy to handle.
President Lee talked about the need for a currency swap agreement in order to avoid any shocks to the Korean economy when delivering these funds. What has Washington said so far?
I haven't heard the exact details yet on how they've responded so far. However, as the president has already stated, that amount currently represents 70 to 80% of Korea's total foreign exchange reserves. Without measures like swaps or similar mechanisms, the impact on the Korean economy will be too severe. Also, as a nation that experienced a foreign exchange crisis, public vigilance on this matter is high. I believe these factors must be taken into consideration.
When it comes to the tariff themselves, we still have to see the U.S. actually lowering car tariffs on South Korea to the agreed 15%. And even if the tariffs were lowered, the tariff advantage that South Korean car makers had over Japan, for example, 2.5% before the Trump trade deal, that's going to disappear. How painful is that for South Korean firms right now?
First, the FTA structure between us and the U.S. is changing, and that will create a burden. Naturally, if tariffs drop from 25 to 15%, that will be better, but it's still harder than before, and especially at this point. There's the difficulty of having to bear the 25% until this negotiation concludes. So, in short, there are difficulties. Hyundai Motor and others are facing particular challenges. However, as far as we understand, Hyundai Motor currently plans to navigate this situation without changing its pricing policy for now. I personally view this as a relatively wise approach. The government is reviewing various policy options to see what can be done to alleviate the burden on the automotive sector caused by the ongoing negotiations.
More problematic also for Korean companies has been the visa issue, especially with the plant in Georgia. What sort of resolution can we expect on that front?
Before discussing what kind of solution there is, realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the U.S. We absolutely must find a solution. Several projects are underway between South Korea and the U.S. Without resolving the visa issue, meaningful progress remains virtually impossible. The detention incident dealt a severe blow not only to the general Korean public, but especially to the workers who were actually detained. In the absence of firm assurances regarding their safety, both they and their families are understandably reluctant to enter the U.S. again while this matter remains unresolved.
Are investment projects right now halted until some resolution is acquired on the visa issue?
Although the projects have not been entirely halted or formally placed on hold, it will be very difficult for a large number of workers to enter or re-enter the U.S. until this problem is resolved.
South Korean firms are also seeing challenges, for example, in China, especially when it comes to U.S. chip restrictions for Beijing, Korean firms operating in China. How can South Korea manage the growing tech rivalry between China and the United States?
That's a problem the whole world is grappling with. It's a natural concern, especially for countries like Korea that share significant economic ties with both the United States and China. Naturally, we strive to maintain good relations with all neighboring countries. However, we understand that the overall plate we stand on has tilted slightly compared to the past.
In what way?
The terrain itself has tilted towards strengthening our relationship with the United States. I can answer it in that way.
What does that mean for China-Korea relations then?
I think China understands this too. If Korea, standing on this larger terrain, demonstrates appropriate efforts to maintain its relationship with China, understanding the changed terrain, then even on that terrain, Korea can still strive to maintain its relationship with China.
But the U.S. has had so many demands for South Korea, including, for example, raising defense spending, 5% of GDP, as for NATO, for example.
With respect to defense spending, I do not believe it must necessarily be considered in connection with our relations with other countries. Rather, it is an area that can be expanded as part of strengthening our independent national defense.
By how much?
Recently, we mentioned 3.5%, and we did so because we judge that this is a level we are capable of sustaining.
Are we expecting any contact between North Korean leader Kim Jong Un and President Trump during the upcoming APEC summit?
Both of them are currently evaluating the relationship between the two parties positively. Since unforeseen events can always occur, I believe we should keep that possibility open. But so far, North Korea and Chairman Kim Jong Un are showing no signs of changing their stance.
President Lee created a positive foundation for South Korea-Japan ties during his last visit to Tokyo. We might see a leadership change in Japan. Could this have an impact on Korea-Japan relations as well?
We hope that won't be the case. We believe it is undesirable for relations between nations to be significantly impacted or altered by changes in leadership. While we also face various challenges, we have prioritized diplomatic continuity and are working to further improve relations with Japan. Regardless of who becomes Japan's new prime minister, we expect and hope that they will consider various factors to ensure that the current, newly formed friendly atmosphere is not adversely affected.
That is South Korea Prime Minister Kim Min-seok speaking to Bloomberg's Shery in Seoul. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.